Hello and welcome back to All Things Money. I'm your host, David Blain. Thank you for joining us today. If you missed the first segment, we were talking about why we don't think you should add your child's name to a bank account. And if you missed that segment, head on over to the website, dlblain.com. We'll post archived copies of the show there in about a week. But I went through, 6 or 7 different reasons why we think that's not a good idea. It's I think, good information for you. All right, so this segment I want to talk about bonds again. We've been talking about this for several weeks. As you recall, the bonds have had a rough time this year, especially in the second quarter. People getting a little panicky over bonds. Ben Bernanke saying that the Federal Reserve is going to wind down its bond buying program, and interest rates immediately spiked up. People started selling bonds. We've been advocating for a more rational approach, focusing on your long-term goals. We've gone through various statistics that show, from 1947 to 1982, when interest rates went from 2% to 14%, we saw that the well-diversified portfolio made the exact same rate of return, somewhere around 11%, as the well-diversified portfolio from 1982 to 2012. And so in that context, we see that no one has the ability to time these markets perfectly. And so we see that in rising interest rate environment or declining interest rate environments, that the diversified portfolio performs relatively equal amounts. Now, okay, so we've been hearing a lot, maybe you have in the press, about this great rotation, sell bonds now and ask questions later. Just get out of the bond market. We think there's 4 reasons why this is not really a smart idea. Now, we're acknowledging, and we acknowledge the fact that going forward, bonds are not going to return the 7% a year that they have previously. Retirees that retired in, the 90s, could stick their money in money markets and treasuries and relatively safe type investments, sit back and collect a relatively risk-free, 6-7% per year. I mean, it was a great boon for people that had the forethought to put money into bonds. Now, going forward, the returns for the bond market are going to be more like 3-4%. Take a little bit more risk, you may be able to get 4.5-5% out of it. But taking more risk, the highest quality bonds, you're not going to get more than 3% return going forward. So a lot of people have been saying, well, just get rid of the bonds. Just why do we even invest in it? Just get rid of them, put it all in equities. And I think that's the big question is, okay, if you're going to sell your bonds, what are you going to do with the money? And that's what we want to address here today. There's some choice. You can keep it in cash, which over a long period of time is a really bad idea. Now, if you're going to have to spend the money in the next 6 months or a year, it's a really good idea. We like people to put their money in cash, their spending needs. Don't have that thing in the market if you're going to saving for a down payment on a house, next spring. Don't gamble with it. Just move it to cash or really short-term bonds. So what are you going to do with, once again, we'll go back to, okay, if you get rid of the bonds, what are you going to do with it? Equities, hedge funds. We're hearing a lot that hedge funds are a substitute for bonds. And I don't want to get into it today, but I'll just read you the headline here. This was from Bloomberg on July 11th. The headline in Market and Finance, hedge funds are for suckers. Sorry, pardon my French, but anyway, we don't think hedge funds are a good substitute for the bond portion of your portfolio either. So what's someone to do? Well, let's talk about a couple of things. Number one, short-term movements in the market should never dictate long-term investment decisions. So whether it's the equity market going up a lot or going down a lot, or the bond market having short-term fluctuations should never drive your long-term strategy. Now, looking at a multi-year period and looking at your goals and projected returns and things like that, you may choose to adjust your strategic allocation and say, well, I think I'm comfortable with more risk, or something like that. That's different. What I'm talking about is looking at, oh my gosh, my statement, my bond funds or whatever went down 5% in the second quarter. I'm getting rid of them. That's a reaction to short-term movements in the market. It's a very, very bad way to manage your money. And it's rarely rewarded in the marketplace. I mean, that's the thing. It's not just, why do I even care? If you're moving in and out of the market or making decisions based on what's on CNN, it's just simply proven that it's a bad way to manage money. The majority of people that make short-term moves in and out of the market, switching bonds, cash, things like that, are much worse off in the end. That's just the facts. Now, I'm not saying there isn't somebody out there, sitting at home all day that hasn't been lucky in the past and made some good moves. That's not what I'm saying. But on average, the majority, and by majority I mean like 95% of the investors are worse off by making these short-term moves. Maybe you're the exception. Most people that think they're the exception is actually a combination of luck, just blind luck that they were able to do it. And then when they go along the next time using that same formula or same strategy, they get wiped out. Well, that brings us almost to the end of our second segment here. When I come back, we'll continue talking about why we don't think a short-term reaction to what's going on in the bond market is a really good idea. So for All Things Money, I'm your host, David Blain. We'll be right back after a few short messages.